Mr. Walker told me to just because he wasn't here.
end the meeting.
Yeah, and the meeting. Sorry.
Okay.
Okay.
And now we'll still.
Is it like March?
No, will be end of February, middle of. See, no, will not be too late. We try.
Defense motive for this year is let's do super stupid stuff like World Life Island.
Okay, that is the code. So try to log in before we start the class. Let's see. So essentially, today we need to start from where we left. That was about securities regulation. We start with the introduction. Before we start about doing this, is there any question in relation to the past? About last week. Then essentially next week, Professor Douglas will teach you about intermediaries under UK regime. And then we will go before the break, because there will be a reading week. Before the reading week, I teach you about EU regime in securities law. So in some way in this course you have a comparative approach. You have a bit of US, UK, and then EU. And then also when you go after the break, in all the single specific lectures, there you will find out that we always take this comparative approach. So you will have now the reference theoretically, and then the specific lectures, they reflect that training. So that you have for each specific topic everything you need for that jurisdiction. You don't need in reality then to be an expert about every jurisdiction. For example, in the exam, that is at the end, it's an essay, not an exam. An essay, you pick one, we give you 4 selection, 5 selection of essay titles. You pick one, some of them, they might be tailored to something specific. So you might have a question that already directs you, I don't know, on the regulation regimes of sparks under US law. So sometimes we give you directions. Other times the question might be free, and so then you can pick the jurisdiction you want. The fact is that because we teach in these macro areas like US, UK, EU, it's better to use the macro areas. Don't use your own jurisdiction. Or if you want to use your own jurisdiction like Kenya, for example, you might do, but for a very small aspect of the question, because we are not an expert of that jurisdiction. So we cannot test your knowledge. So you cannot write an essay that is all about Kenya securities laws, because that's not making sense. Although some questions might give you freedom, but it's better that you rely to this framework, to the framework that we were teaching you. So, in relation, for example, today, we will examine something also related to IPO, primary markets. So all these things are important because this course is about securities laws. Any question that you have about IPO, because it was only 1 hour, little bit more than 1 hour last time. So, do you have any question about that? No? Okay. So we can go further, and we can start to speak about the terminology. So why, if you remember in the first lecture that I gave you last week, I asked you why we use the terminology of securities regulation. And actually the terminology is derived directly from one body of laws, that is the body of laws elaborated by Americans in the US, where they define that body of law as securities laws. So that is something that originally, from a financial history point of view, derives from US. And the main acts of the US, as you can see, are the Securities Act 1933 and the Securities and Exchange Act 1934. If you see in terms of years, 1933, 1934, what happened in 1929 in the US? Yes, there was the crash of Wall Street. So in reality, that crash of Wall Street directly relates to the banking sector. So it's not directly related to securities, but still in securities they started to experience more a level of frauds that was higher. So for this reason they were thinking to reform their own financial system. On one side, on the banking side, there is the Banking Reform Act, and so that is the act where also the Federal Deposit Insurance Corporation was established in the US as a form of deposit insurance for banks. And then we have all the other set of rules that they relate to securities. So securities, just to clarify, because maybe some of you were not here last week, we said that securities are essentially of two main typologies, debt and equity. Specifically, once we speak about securities in a course of securities laws, we almost always refer to equity. Because why? Why we always refer to equity majority of times in securities laws? In reality, you have an hint from last week. What can be? Yes.
Maybe because they are more riskier than that instrument, because there's no duty to.
Well, it depends, because like if for example I buy a bond, and there are some bonds even now traded in the London Stock Exchange by private corporations or listed corporations, that actually they are even promising you a high return in terms of the interest rate that they produce, like even 7–8%. But even there you take risk, because potentially maybe the company will not pay you back. So you take the risk also that the company maybe is going to fail, so it's not solvable. And that is something that then also affects your investment. So the risk is everywhere. Risk is in debt, risk is in equity. But maybe you said one point that is right, equity is riskier than debt. Why?
Because there's no duty to give your money back.
More or less.
I understand where Pierre is going, and asymmetry and you have to protect consumers. So the bond market is for much more sophisticated investors, let's say, while the securities market is targeted to the general public. And when in this case we're talking about equity and we want to protect those public investors.
For example, if we think about debt and equity, and we think about those that they are listed on the market, so both they have a prospectus. There is a prospectus if I buy a bond, there is a prospectus if I buy shares, there is disclosure of information in both. So what is the main difference between the two?
For bonds, you get interest.
Yeah, the
So
bonds,
interest,
yes, is paying back in interest rate. Yes.
and it doesn't fluctuate in terms of if you own a share, your share can fluctuate.
Ah,
You
okay.
don't always have
But
dividends.
we can
so
have
there's
a
no risk.
fixed rate of interest, but even variable rate of interest. I mean, the interest depends on the
But your share
prospectus.
price can fluctuate.
A share, yes, by definition can fluctuate more in the sense that once you are trading a share on the market, the share can go up, can go down, there is volatility in the market.
Which is more riskful than having a bond.
Yes, in this part, yes, in this argument in some way is true, in the sense that if you buy, for example, bonds, UK gilts are sovereign bonds of the UK, that is giving you a low interest rate, but is something that usually is always paid. So the UK will honor that obligation to pay you the interest, but it's very low in some way in comparison to equity that, for example, if now we have seen the development in the US, if you hold equity from American companies today, some of them they are also 9-10% higher than 3 weeks ago. So in reality you might have higher return in equity, but also it's riskier because in reality there is more volatility in the market. This, yes, is one aspect for sure, but there is another aspect also. Why debt is more secure. If I buy a bond from a sovereign state, if I buy a bond from a corporation, it's the same in reality. There is even there is volatility, but less than equity. But actually, there is a guarantee in some way in both, in comparison to equity. Which is the guarantee? Yes.
Well, solvency.
Yes, is that the solvency?
Bondholders will rank higher than shareholders who
Yes.
usually get nothing.
Is that so substantially, if I am a corporation and I'm offering you debt or I'm offering you equity, there is a difference because once the corporation is going to fail and so is declaring the state of insolvency, some of you will take corporate insolvency with my colleague Rodrigo Rivera Scandal. There you will see that then once we open the insolvency state, there is a sort of hierarchy of creditors. So once you buy a bond, you are a bondholder, you are a creditor of the corporation. And usually you rank at some point of this pyramid. So there is a hierarchy where there are secured creditors, usually banks of the corporation. So are creditors of the corporation that they are at the top. They must be repaid first. Then there are others and others. So there are different kind of creditors. We will not go in these details here because it's not our lecture. Our lecture is about securities and securities laws. But it is already to let you understand that this is why if we buy equity, it is riskier than that. It is riskier because equity at the end is a residual asset. So in reality, after the company has sold off all the assets of the company, paid off all the creditors of the company, they pay shareholders if there is anything outstanding. If there is nothing outstanding, the shareholders will get zero. So they rank at the bottom of the queue. Because they rank at the bottom of the queue, higher the risk, higher the profit. So in reality it's true that if you invest in equity, you might gain a higher profit, but you might even lose everything, essentially. So risk is everywhere, but risk also determines then the choices of investors, where you want to invest. If you are an investor that you don't like risk too much, you will invest in bonds. And in fact, I mean, if you start to have more money in your bank account, Barclays or all these banks, they offer you saving accounts, but they pay maybe 2% interest rate, very low, 3% interest rate, not too much. And then they offer you bonds, Barclays bonds, for example, 3.5%, maximum 4%, and no more than this. But if you have equity today in the US, you are at 10%. So there is apart volatility, there is an exposure to risk that is much higher, and this is why you might get a higher return. And then it's up to you. At the moment that they trade at 10%, you might decide to sell and you cash in a profit that is much higher than holding just debt. But debt is important for the corporation because in this way they finance themselves. So in reality, this is how the economic system works. Now, coming back, this Securities Act 1933 and the one 1934, and especially the one Securities Act 1933, they relate to the discipline of securities both in the terminology of debt and equity, but their main focus in Securities Act is on primary markets, IPO, initial public offering, and when the issuer is issuing for the first time new shares on the market. So that is the main discipline that you find in the Securities Act 1933. And why that act has this main focus on primary markets, that are the markets where we have one issuer that is issuing for the first time shares to the market. Shares that, as we said, I mean, might be riskier than debt for sure, especially in the event where the corporation has to be delisted or even has to, in the worst scenario, go through insolvency. All clear? Then we go to the second pillar, let's say, of securities regulation. One pillar is statutory law, because Securities Act, Securities and Exchange Act are federal acts. So the United States of America is a federation, and those are acts of the federation, so they apply in all the states of the United States of America. Then each single state of the US, they have their own laws in terms of securities laws. So that is called blue sky laws. You can even have a look on Google and find out, even on Google Scholar, many papers. Some of them are already uploaded in the readings of last week, where you find this kind of evolution of securities laws in the US, where they started with national laws in the national states, and then this kind of confusion was in reality solved by these federal acts, that they apply general principles, especially the Securities Act, if you read, is quite short, is full of general principles of securities laws that then are applied or are followed by each state in the United States of America. And still today, the blue sky laws, they apply in the US, so each state can have its own securities laws, but still the focus there will not be on regulating IPO. The regulation of IPO is in the Securities Act 1933. What you find there at the national level will be an act that maybe is going to detect when there is a security fraud, how litigation is conducted in that case. So securities litigation that has a great prominence in the US classes, if you are taught by US professor, and this was not UK, it was US, we must have in each state one part of the class dedicated to securities fraud and litigation, because it will differ in each state of the United States of America. So still, this body of the law that are at the federal level, there is another body of the law in each state that still add up to the federal act, but more in terms of catching security frauds. In fact, security frauds in the US are a big concern. We will see also in the special purpose acquisition companies at the end of this course, there is a class dedicated to this because I am one of the main experts in the subject. And we will see that actually there was quite many kind of class actions, litigation in securities, and that was due to the boom and bust period of the SPAC between 2020 and 2022, where possibly some few of the SPACs, they performed security fraud. So they told to investors many times things that were not real, things that then they didn't happen in practice. And so the investors, the public investors, those that they bought shares and securities on the market, they had a detriment. This is why, in reality, these first lectures are important because you have the frame in your mind, and then once we go in practice and we show the examples, you can connect and you understand, essentially. The other pillar, so one pillar is the federal act or the act of the parliament in general are at a higher level because actually statutory law as a source of the law. And then we have self-regulation. Self-regulation is something that, as the slide then shows, it was very important, still important in the City of London. So the second pillar of securities regulation is derived more from the UK, while the pillar that is more statutory law and the general framework on how primary market works and secondary market works is more related to the US. And in both cases, in general, the main focus has been on disclosure. So the fact that the issuer, once it's going, for example, to start an IPO, you must disclose information. So still today, if you work as a security lawyer or in the capital markets, you need to write prospectuses. So that is something that also now I'm involved probably with a SPAC that wants to list in London, and that SPAC will have in reality a lot of disclosure through the prospectus. So disclosure is a principle that has always been at the core of securities laws in the US, and then from the US has been transferred in the world. So many other jurisdictions in the world, and even in Europe, and even in the UK, and many others in the Commonwealth and so on, they follow this principle of disclosure. But the principle of disclosure has a point that, can be a problem. The problem is that if I am the one that I'm going to disclose information, I am the issuer, maybe I'm going to lie on those disclosures. And this is the problem, that there is information asymmetry in the market. So because there is information asymmetry, we don't really know how to catch the good issuer from the bad issuer. In fact, here you can even read a paper of Akerlof that is speaking about the lemon market, saying that in a market of lemons, all the lemons are yellow and they look the same. So how I can distinguish for real something that is good from something that is not? Actually, disclosure is one sign to distinguish the good issuer from the bad issuer, but it's not enough, because still the issuer that is a corporation is directed by men that are human beings. Human beings, you cannot control the subjective element of the human being that might go into fraud, that might maybe avoid to disclose information that should have been there. This is the reason why you have a regulator. So the regulator, usually you work together. So once you write the prospectus, and this is something that maybe the lecturer before didn't go a lot in details, but once you write a prospectus, you will write this prospectus in tandem with the issuer. And then you present the prospectus to the regulator. The regulator has to approve the prospectus. If the regulator thinks that there are some parts of the prospectus that in reality they need to have more details, they will ask for integration of information. And this integration of information you must comply with, and is based on disclosure. So you need to disclose what they ask you. If you follow this, majority of times you are fine. But it is not enough, because if there is something that the regulator cannot be aware, but you are aware because you are the issuer, still there are some, in the case of the US, some security forms that you can fill in and you can disclose to the market. And this is good because you will be a good issuer, And generally saying, you might also signal to investors that you are reliable. Here, as we said, if you remember, there was the diagram of financial markets, the lender, the borrower, and so on. We said that that kind of system is based on trust. But also here, even in securities and even in IPO, trust is key, because the public investor has to trust the management of that company and has to trust the disclosure, the level of disclosure that is there. And so in the United States, I mean, this has been the main principle that then has been developed throughout the world. And then during the collapse of the Soviet Union, that is the moment where the regulation of the US has also expanded through the world, and has expanded through the role of IOSCO. So IOSCO that we saw, that is a standard setter. And so in the international financial architecture, IOSCO sits at the top at the international level, but actually is issuing recommendations. So an example of soft law. This example of soft law, in any case, then becomes harder than hard law. And that is possible through essentially this kind of principle through which, if you are a member of IOSCO, you tend to follow what they say in recommendations. And those recommendations many times are based on US securities laws. So that is how the US then became, in reality, the main point of reference to all the other jurisdictions in the world in terms of securities laws, because we speak about IOSCO. Is fine? All clear in your mind? Yeah.
Say for example, I'm issuing or subscribing to a prospectus and get a review of the company or account from a third party. So,
Sorry, tell me again.
I'm issuing shares. I'm purchasing shares through the IPO or prospectus. And I appoint a third party to go through the financials and give me an opinion on the company. So will that company or the third party be accountable, or is just that can we hold them accountable if they don't provide adequate risks or analysis?
But I mean, for example, many times this is the role that we will see is played by rating agencies. So a rating agency is the example that you say is a third party that is independent and is giving a rate to the solvability of the issuer, for example. And so in this way, under many parameters that they take into account, they say if you invest in this security that is a bond, we rank this bond AAA. So there is a high level of solvability, there is a high level of investment return. But then this is the point, what it is this? It is an opinion. So you are just in reality relying on the opinion of a third party in order to invest. And so that was the problem of the global financial crisis, because there were many instruments in the market that were CDOs, and these CDOs in reality they were ranked AAA. Many investors they started to invest, but in reality they were not reliable. And in fact then once there was the crisis, everything collapsed. And those investors they were not compensated by the rating agency. Then they were, and we will see there is a specific lecture that is speaking about all the rules and regulation that were enacted in order to discipline the work, the job of rating agencies. But still, even today, that is just a mere opinion. So you cannot rely with blind eyes to that. There is another point also to say, if you are a public investor, it's not the role of financial markets to make you rich. So in reality, you take risk, otherwise the game cannot work. So you might even take risk. The important point is that if you take risk, you know what you are doing because there are disclosures. Because as far as there is disclosure, as far as even in the prospectus is written risk factors, for example, the SPAC is a special purpose acquisition company, and so it's not an operating company, it is a cash shell vehicle. So if you state all this information, you state also the target market that the SPAC is targeting that might collapse due to many kind of development in technology, because we target AI, for example, and maybe there might be a bubble in AI. So as far as I disclose this information, you invest in my SPAC, it's fine, because I told you that was risky. So you are taking responsibility. The system has to work in this way. For this, the system of disclosure is important, because more disclosure I give you, and if you trust me, in fact, we said everything is based on trust. If there is trust, then everything is fine. You should not claim that I didn't advise you before not to invest there because it was too risky. You wanted to take risk because you wanted more profit, but you also, at the end of the day, it's your own responsibility. But you will see that many times the focus, especially if we think about consumer protection and all the things that all this course will speak about, in reality there is a big focus on retail investors. Because if I am an institutional investor, I am an intermediary, so I am an hedge fund, a mutual fund, I have my team of analysts, I can understand even better than every physical person securities. I take a risk that I know how to take, but also I have enough resources that if I lose everything, I still have money. While, for example, if you think about families, retail investors, physical people, you might lose everything you have because you are investing all your savings there. And that is something that, of course, can create concern, but it's also true. For this reason, some offering is not directed to retail investors for this reason. So unless you are not a wealthy individual that has at least 5 million under management, you cannot invest, and it's done on purpose. Other times, smaller retail investors, they can invest, but at their own risk. As far as, of course, there is a good level of disclosure. But the disclosure is something that sometimes I might even disclose fake informations that are false, and so I might trigger the interest of investors just to get money and to use the money for my purpose. And in reality, maybe my purpose is dodgy, or my purpose was never there, and that is something that you can, in that case, you can start a litigation against the issuer, because you were like tricked in something that you didn't know was in that terms, based on the level of disclosures.
That come under the ambit of warranty or a representation when we...
Yes, it's like a sort of representation and warranties, that is more in a contract, like in a share and purchase agreement, and that is more legal document. So once you disclose an information, yes, usually is an information that should be real, because the same issuer has a responsibility to what you say to the market. But then still, today, some issuer, they can disclose information that are not real, and then they are dragged into litigation. But this is more in the US. So in the US, there is this kind of culture of class action, securities litigation. In Europe, no. We don't have this culture, because also in Europe we have a different kind of investor. The investor in Europe is investing in real estate. So in Europe, to be rich, it means that you own many houses. In the US, it means that you own many securities. So it's completely different approach. This is the reason why also there is a higher level of litigation in the US in the cultural background in comparison to Europe, for example. But also here, if you see the Chicago School of Economics, they started to also try to challenge this level of disclosure, because they were starting even to say, if you disclose information, but sometimes who is going to verify this information if the information is coming from the issuer? You are disclosing what you know, but maybe what you know, because there is information asymmetry in the market, is not the same that what we know from public investor perspective, because you are an insider of the firm, and the public investor is an outsider of the firm. So for this reason, the focus shift after this failure of Enron, WorldCom, are things that you can even look by yourself, and shift, yes.
Did you say that in the US they have an equivalent of the prospectus? Is it some sort of form?
No, the US has the prospectus. Every jurisdiction has a prospectus. It's called prospectus. then can happen that it depends where this prospectus is drafted. If we speak about New York Stock Exchange, Nasdaq, regulated exchanges, and also London Stock Exchange, Singapore Stock Exchange, Hong Kong Stock Exchange, Euronext, all these, every time that you issue new securities on the market, you have to submit, to fill in a prospectus. It's called prospectus. It's the same. So there is the name of the issuer, there is the data related to the company of the issuer, there are balance sheets that are attached, at least 3 years of balance sheets, and then those balance sheets are audited, and then there is written also why you are offering those securities, how much those securities are sold to the market, if there were previous investors, because sometimes in an IPO you might have also investors that are qualified investors, that they are the client of the investment bank and they are going to join this IPO and already to buy some securities before they are listed on the market at a discount. So that is the advantage that they have. But that is done also to facilitate that you can, as an issuer, sell all the securities to the market, because then the percentage that you need to sell is lower in comparison to sell everything without the help of institutional investors. So prospectus is the document, and actually is a contract between the issuer and the new public investor that is the one that is buying the securities. Now this contract, you don't need to think that it's only between the issuer and the public investor, because this relationship cannot be so direct. In reality there is a broker-dealer between the two, so you need to submit the request of purchasing the security to the broker-dealer. The broker-dealer will submit this to the issuer, and then in some way this transaction is settled. So even, I don't know, if you have invested in financial markets, you have seen that you can even give different orders, different typologies of orders every time that you buy securities. You can buy at best, you can buy at a certain point once the trade may be below or above a certain threshold, and so on. But once you are doing that with your app, that is a secondary market. The securities are already traded. While here, in reality, the securities that we speak about are on the primary market, so it's the start. It's the first moment when, for the first time, we'll sell securities, and there is a prospectus. The prospectus then stays there, actually. But if you are in other markets, because, for example, in the London Stock Exchange, but especially Euronext Italy and Euronext Europe, we have other forms of multilateral trading venues that are less regulated than regulated markets like London Stock Exchange. It is, for example, the alternative investment market. So the alternative investment markets is a market, capital market, for small firms, small, medium firms. So you can raise less money than an IPO on the regulated market. But also for this reason, because there is less regulation, it is more dynamic, and so, for example, you still submit a prospectus. But this prospectus, for example, will have less pages, is shorter document. It's shorter document, and in fact, it's called an admission document. It's not called prospectus. Just to signify that actually the prospectus is the more formal document that usually is for a regulated exchange, and then for other market segments, we might have a facilitated form of prospectus. It's always a prospectus, but with less disclosure. And that is something that in any case is verified. In fact, I was going to say that the Chicago School of Economists has started to challenge the idea of disclosure based only on the knowledge of the issuer, because you can perform fraud, or you can omit some information. So you need some people that they check. Who are those people that they check? Those monitors. Who are? Are lawyers, accountants, and then investment bankers. So the investment bank So there was a time in history where at some point they said that the investment bank will be the gatekeeper of financial markets. Without going through the investment bank, you cannot tap public markets. Still, today there are a lot of financial innovations. So for example, today you can have a direct listing. You can directly offer to the market shares that are already in your company without issuing new one, without an investment banker. So in reality, there might be other forms of possibilities, alternative ways to get listed, but this is something that, is more part of corporate finance as a discourse. This is something that more relates to securities laws, but is to let you know that there are also other forms. And the special purpose acquisition companies is one of those forms. There is another form that we will study at the end of this course, that is the SPAC. So it's always an IPO in a different form, where the investment banker also will charge fees that is much lower than the IPO. And why? Because there is less job to do, because that is a cash shell company. So there are no balance sheet, it's not operating company, there is less to verify apart from the validity of the management. Apart from that, there is nothing that the SPAC has as an asset. While operating companies that they grow and then they decide to get listed, they have a financial history. And so there is much longer to be verified. There will be accountants that they verify a balance sheet and they certify balance sheets. Also there, in reality, an accountant like PricewaterhouseCoopers can perform fraud because can certify a balance sheet saying that everything is fine, that there is not a misstatement of balance sheet. In reality, there is. And this is something that happened because I was working, for example, in the Financial Conduct Authority in this country, and I saw a case of that is public now, Red-Centric. So Red-Centric was a corporation here in the UK that actually they had many workers and many employees in India, and they delayed payment of those employees for more than 1 year. In this way, it seems in the balance sheet that they had more cash on the balance sheet, but was not true because that cash didn't belong to the company. There was a legal obligation to fulfill, but was not disclosed and was even certified by PricewaterhouseCoopers. So this thing can happen. So in reality, this kind of monitors are there to avoid this to happen, but still this can happen. It's fine. So the gatekeepers are investment bankers. In fact, even today, if I need to list a SPAC in London, without an investment banker, we cannot go further. In fact, now, yes, on the paper there is the form of lawyers here in London. On the paper there is me as an advisor. On the paper, we need now to see whether there is an investment banker that wants to list those people, and think also, another point that is very important, whether in this moment, specific moment, London as a market is a good market to get listed. Might be not. And so maybe it's more valuable to be listed in New York, that in this moment is much better. So those kind of decisions then are discussed with the investment banker, but without the approval or the conviction of the investment banker to go further, this cannot be done. And usually investment banker, of course, or you are a client of already of the investment banker, and so in this way it's simpler to get listed. If you are not a client, they will verify, and that is the verification. They will verify that you are who you claim to be. If you say that you are an Indian family connected to Sunak, and in reality you are billionaires in India, this is fine, you can say on the paper, but then we need to verify that actually you have all this information, that there is this connection to Sunak, that Sunak really knows you. All this kind of verifications is from the gatekeeper, that is the investment banker. Investment bankers in a period like COVID, for example, another thing that they perform usually at this stage is to go directly to the company, to see whether you own the office in Malaysia, to see whether you claim that you have other 3-4 offices in the country and you are also investing in real estate. We want to see the investments and we want to see what you really own. and so they usually travel. In COVID, they could not. So in reality, this is the reason why in COVID there was a boom of IPOs, because there was one type of verification that could not be performed, and there was a boom in IPO, in fact. I mean, this is one of the parameters. It's not the only reason why, but this reason is also a good reason to list, for example. So once you are a businessman, you need to decide when to get listed. You need to decide in accordance to all these parameters. So it's not only then the market, it's also the historical moment, if there is a high level of inflation, if maybe debt is more in reality in vogue in that moment, so it's not the moment to list securities in the form of shares, for example. So there are different rationales. Those rationales then are more explored in corporate finance, but corporate finance, I mean, we were teaching you at the start of the term. If you took the class, you already know. If you didn't take the class, we cannot do much now. So, any questions so far? Then, this kind of disclosure principle that is enshrined in the Securities Act 1933 is providing this mandatory registration process. So you need to register securities with the Securities and Exchange Commission, that is the regulator of the US. The equivalent in Europe and in the UK, it is the Financial Conduct Authority. And then in Europe, although we are not the United States of Europe, I will show you that actually in each jurisdiction there is a regulator. In Italy, the equivalent of Security Exchange Commission and the equivalent of Financial Conduct Authority is CONSOB, and so on. There are all member states, they have one single regulator for financial markets, that they perform the same kind of control and checks that I was telling you until now. So the type of checks, the type of process of IPO is the same, because it's based on this idea and this model. And here you have, for your knowledge, but it is something that, I mean, you are not obliged to study securities laws in the US, because we are not in the US, but those are the provisions of reference. In Section 5, all issuers must register non-exempt securities with the SCSC. Section C, the registration of securities, and how these securities are registered through the prospectus, on the basis of the prospectus, and then the issuer must submit also any additional information. The additional information is another thing that I was mentioning you before. We need to submit additional information if the regulator is asking us, or maybe we do on ourselves. We want to disclose, because the more disclosure there is in the market, the less potential liability and litigation will be in the future. If you are in the US, you need to do, I mean, you need to be very careful. Even if you missold something, is something that then later can be catched by one even small investor. Even a minority shareholder that only has 0.1% of shares can drag you in a litigation or class action. So US, you must be very thorough. In the UK, in Europe, this process in reality, I mean, is different, because you can already see and appreciate the US is on this side of IPO primary market with the Securities Act 1933. The UK, the Europe is different, it's more on consumer protection, investor protection, so there are a lot of rules that already provide protection to the investor, and so for this reason the level of disclosure, if it is high or low, in any case there are so many provisions that the investor will not be defrauded. It's fine? This different rationale is very important. So how the Act born and how developed then in Europe and the UK. And then the Securities and Exchange Act, that while the Securities Act is more philosophical, has all these principles-based definition of securities and so on, and is focused on primary market, the other, will be something more related to secondary market. So the Securities and Exchange Act has more to do with the selling of securities investor to investor. Once the security is already on the market, once it's traded on the market, we need to examine investor to investor. So in reality it's a secondary market, because this is something that you can connect to the history that I was telling you of the VOC in Amsterdam. In that moment of the Dutch Republic, they started to sell share certificates to other investors to obtain liquidity. And that is where there was a secondary market. So secondary markets paradoxically born before primary market in financial history. And still today, so we have a Securities and Exchange Act 1934 that is dedicated to the regulation of those trading of securities. And the Securities and Exchange Act also is going, for example, to govern exchanges. So exchanges, physical exchanges like London Stock Exchange that you can see in St. Paul, is a physical building. In reality, they born from self-regulation. And this is something that I think I told you. If you think about London, all the markets I told you last week were born from informality, from self-regulation, from the fact that they meet in a square. Then they develop, maybe in this country, coffee houses, and then from coffee houses they went in the London Stock Exchange, that is the actual exchange. But those exchanges that they in some way regulate the issuance of shares on the market, but also the investor-to-investor trade, the secondary market, can generate systemic risk. And so this act in the US is going to govern exchanges also in order to prevent the spread of systemic risk in the case the exchange is going to fail, for example, or in the case maybe every time that I buy securities I need clearance and settlement. Those are processes, and if, for example, there is clearance but there is no settlement, I don't own the security, but maybe I paid for the securities. And so that is something that can generate systemic risk, especially if the exchange is going to fail, who is going to transfer the security or is going to pay for the security. So there will be clearing houses. Clearing houses are within the exchange usually, and they are founded by members of the exchange, all the issuer and other members of the exchange. And here you have then some forms that are used in the US. So are other forms of disclosure that once you are listed on the market, and I think, the lecturer before last week was speaking to you about this continuous obligation. Once you are on the market, it's not the end, that you follow a process. But then on the market, you need still to continue to disclose. And this disclosure is done, for example, in the US with these forms. Form 10K for filling of annual reports of the corporation. Quarterly reports will be Form 10Q. Form 8K for important events. If, for example, you sell one line of business, and so there is an M&A process, you need to fill and inform the market and the regulator with a Form 8K, and so on. There are so many forms. But it is more something if you want to practice law in the US. But the same kind of rationale exists in Europe, exists in UK, exists in all the world, because all the world has copied and pasted US. Fine? Then in the United Kingdom and Europe, actually everything born through the, in the case of the UK, through the Financial Services Authority. This is something that after the break we will study, because I need to introduce you to the Financial Conduct Authority, that today operates in tandem with the Prudential Regulation Authority. But before this moment in history, before the Financial Conduct Authority, before this Twin Peaks model, there was the Financial Services Authority, so one single regulator. This single regulator was also in charge of securities regulation in the UK. But of course, at that time, that was one of the challenges, because if you are in charge of securities regulation, but you are in charge also of banking regulation and supervision, at some point there are too many objectives. And that is something that even today is under the scrutiny of the House of Lords. For example, Lastra was part of an inquiry on the new competitive objective of the regulators in this country, because this new objective in reality is not the main objective to preserve market integrity or to supervise the financial systems in order to avoid systemic risk. This is a new additional objective that now the regulators, once they regulate, they should regulate or supervise in a way that makes the UK competitive in relation to other countries. but the competition objective is new, just adopted in 2023 in this country, and is not something that is promising, because actually we already saw in the past with the Financial Services Authority that things they can go wrong. And in fact, at the time of the Financial Services Authority, there was Northern Rock that collapsed in the UK after the global financial crisis, after the collapse of Lehman Brothers in 2008. So during that years, also here in the UK, Northern Rock failed, and failed for a lack of supervision of the Financial Services Authority, because there were too many objectives actually to look at. So they started to see that it's better to divide task between regulators. In fact, this division of task, I think even Douglas told you at the start, in the US is quite clear, in the sense that there is the Securities and Exchange Commission that will be in charge of securities markets to preserve market integrity for issuers in primary markets, and then there will be another regulator for derivatives that are another product. They might also overlap with the concept of securities, but still in the form of a financial contract, that is the derivative contract. And so it's right that probably the futures commodities regulator is in charge of those aspects. If you take with us, with Douglas and myself, the course on derivatives and risk management, we will see further about those elements. So now here you see the other aspect, that is more the Securities and Exchange Commission, the Financial Conduct Authority, the European Securities and Markets Authority, that is the ESMA in Europe. So Europe is an international organization. At the top of this international organization, in relation to securities, there is ESMA. It is located in Paris, and is where actually you can find all the technical rules and standards, recommendations in relation to securities laws in Europe. Then those kind of recommendations, or sometimes technical standards, are then implemented in each member state. So you still need then a national law to follow those recommendations. Otherwise, a recommendation, we said, is just soft law. A guidance is soft law. So you cannot, you need the cooperation of member states in this regard. And then UK actually joined in 1972 the Europe, but then now there is Brexit, so they left. But once they were there and they joined the EU, actually the UK has influenced a bit the development of securities laws in Europe too, because actually still today, but even more in that time, in the 1972 was the time of Thatcher in UK, liberalization of the markets, capital markets were founded, and they had a great prominence in London, and still today actually they have, to some respect, less than the past, but in that past, yes, they had a great prominence, while Europe at that time in 1972, capital markets in Europe were less developed, and so they followed the advice of the UK. Now, I told you already this, that is investor protection. So while the focus in the US is more on this primary market IPO, the focus in Europe in general, and Europe, once we speak of Europe of the time, is more within UK. In UK is on investor protection. In fact, this kind of approach of investor protection is the approach of Europe, European Union today. So you will find out there are many directives, regulation, that they all speak about investor protection, but they do this because of this reason, because of the UK that joined the EU, and how the UK could influence the EU. And UK actually, to regulate securities in this jurisdiction, they always relied a lot on company law, English company law. And so this is the reason why today, still today, I mean, English company law is key, and still at that time, still today, I mean, English company law is requiring you, if you are an issuer, to register your securities. While in the US we find this kind of registration in the Act, in the Securities and Exchange Act 1933. While there we find this in the general framework of company law, because actually, yes, corporations, companies are the ones that they get listed. But this is also from a financial history perspective, is connected why this preeminence of company law. Company law to detect and prevent fraud, because in this country, in the 17th century, there was a big scandal that was the South Sea Bubble. I think Douglas spoke to you briefly about that. What you remember, because this is important. I mean, if you are in a course of company law, securities law, and you studied here in the UK, but you don't know the South Sea Bubble, it's strange. What is the South Sea Bubble?
It's a company that, I think it was the first company to trade its equities in the Netherlands, and it also had part of its equity were traded here in London.
The South Sea Company, I mean, that is the East India Company.
Oh,
The East India Company is the DOC and is in Amsterdam. And so that is the start, the born of the birth of the financial markets. And so the first exchange in the world, that was Amsterdam Stock Exchange. So that is the East India Company, DOC. And that is the point of reference for exchanges in the world, and capital markets and secondary markets. But then we have in financial history another moment in history that is here in the UK, 17th century, that was the South Sea Company. So it was a company. It was a company that actually were founded by government also in some way, because this South Sea Company took over a part of the government debt, because UK was fighting the war with France, and so they needed money. So they were founding this war. But to found this war, they started to, in reality, attract the attention of many investors. All these investors they bought shares in the company, in the South Sea Company, with this promise that actually they were going to explore the route of the Caribbean, so of the South Sea and South America. But actually, during that moment, then what happened? Many other people, they started to set up other companies that they were promising things that were not real, I mean, that were promising things that related maybe to the exploration of secret lands, but these secret lands they didn't exist. Just to, in reality, I mean, go get money from investors. And so this kind of shares at that moment were very popular, so many people they were investing in, so the value of the shares went up, but then collapsed dramatically, because actually behind the scene there was nothing. So now, if you read the Financial Times, many journalists, they equiparated the South Sea Bubble, there was a bubble at the time, to the SPAC bubble, because even the South Sea Company was an empty shell, it was not an operating company, just set up for a purpose, to repay the debt of war with France. So in reality, there are similarities between SPACs and the South Sea Company, because also SPAC we will see is set up today in order to achieve an objective tomorrow, that investors they don't even know the company that we are going to buy. We decide in the round. So there are similarities but also differences, because what I claim in the paper is that actually SPACs are more connected with the DOC, while the South Sea Company and bubble is on its own, something that happened here based on reasonable terms, based on real fraud. So something that is completely different and should be differentiated with SPACs that are becoming more a sort of alternative way of getting listed to the market. And it's also a way that we will see is also well governed and disciplined by the Securities and Exchange Commission in the US. So it's a very legal way to do it. So the South Sea Bubble is famous also because at the time there was Isaac Newton. Isaac Newton was a very big investor of the South Sea Company, and actually he lost the equivalent today of £3 million. And in fact after that he said, I can measure the gravity of objects, but I cannot measure the stupidity of people, because actually this is something that remained famous in what he said, to show how in reality speculators, they are dragged to those investments by market sentiment. So there is market sentiment, and actually you always think that something that is going up will go higher, but actually this is never possible. So at some point we'll always, with the law of gravity, fall down. And that is the same thing that happened in the South Sea Company and the South Sea Bubble. But since that time, then there were more laws related to investor fraud, investor protection, company law, registration of securities, disclosure through the prospectus. So that is the moment where English company law was reformed, and also investing on financial markets was modified. Still, although we have evolution in regulation, in securities regulation, we can still experience the same level of fraud. Maybe a bit mitigated, but still is there. So we cannot truly avoid securities fraud, because the way in reality that you perform an IPO, or you list something to the market, or you sell something to someone, is always by overstating the qualities of that object. Even, I mean, people in commerce, they do the same. Maybe they can overstate the quality of a dress, and then you buy for a price that is much higher than the quality itself. And that the same thing happened with securities. Self-regulation, yes, we said. Self-regulation also, born in the UK, and so the City of London, and actually in the City of London, born at the time of livery companies. For example, I am a member of a livery company in the City of London that is the Worshipful Company of International Bankers. There are many other livery companies. Everyone can be part of a livery company, but you need a proposer and seconder. If you don't have this, you cannot enter. They cannot admit you. But apart from this, I mean, you might bump into people in London that they are part of the company, and you can become a member. And for example, what they do still today is that they do all traditions, banquet, things that, or events, in the case of this company of international bankers, they do all events related to finance, to banking, with CEOs of JP Morgan, Goldman Sachs, whatever, where in reality you have also an opportunity to meet in person, maybe in restricted groups. So that is the reason why London in reality born from the City of London and from guilds and livery companies. And livery companies were self-managed, organized. And that is why self-regulation born in the City of London, actually. And then still today we have this self-regulation, especially in the US. So at the time also, if we think before the global financial crisis, the sector of derivatives was mainly self-regulated, because it was based on the ISDA Master Agreement, the International Swaps and Derivatives Association. ISDA, as an association, they were drafting standards in derivatives, and these standards were those applied to CDS, credit default swaps. But the credit default swaps is at the center of the global financial crisis. In fact, some people, they claim if they were not traded through this standardized way of the ISDA, that was self-regulation, and there was a regulation in place, maybe this would have not happened. So that is why self-regulation is something that always will stay within financial markets and securities regulation. It is the second pillar of securities regulation. It is important, but is under critique, because it's based on the opinions and knowledge of the same market operators. So they even say how a criminal can design its own rules. If you are a criminal, you should have the state to decide the rules, and then in case you go to jail. So that is the idea there. And then here, this is just an idea about Europe, but you have a lecture all on European Union securities regulation, and so it's outlining you the process based on influence of the UK and based on influence of the US for disclosure, but mainly based on investor protection, because we said UK, Europe, European Union, they have a focus on investor protection. And of course, yes, the role of IOSCO, in the sense that Europe and everything that Europe has done in terms also of what is called today the Listing Act is done through US input, through IOSCO. Today, this kind of input in reality is different, and this slide is quite important, because today we experience what is unilateralism. So in reality, we have the US with Trump, but Trump doesn't want in reality to be within an international financial architecture. So Trump doesn't like the IMF, the World Bank, IOSCO, and all the standard sectors, because Trump thinks that if I am elected, I was elected by American people, so I need to enact laws for American people, not for the world. And that is something completely different. Then Trump thinks that essentially deregulation is the new terminology in regulatory debate. So rather than putting new rules, we try to cancel off all the other rules that we were implemented before in order to be pro-market. And then we have the approach of the UK and Europe today, European Union, that is quite similar today, is on simplification. Simplification that is different from deregulation. So simplification is to harmonize the set of rules, not necessarily to cancel off rules, but to make them more intelligible, more coherent as a system. So these two systems already you can see they are completely different. So even in securities laws, we have different systems today. There is no more this role of IOSCO that in reality is going to be adopted all over Europe and all over UK. It is something that will be different because before or until the global financial crisis, we have this corridor of policy between Washington, New York, London, Brussels. So this kind of corridor was the corridor through which a policy adopted with the Washington consensus was adopted in Europe, because UK was part of Europe. But today UK is no more part of the European Union with Brexit. So in reality this corridor has been broken. So today we have Washington, New York, arrives to London this policy, but then departs because it has to go to Brussels, and to Brussels there is the European Securities and Markets Authority that is the, sorry, not in Brussels, that is in Paris, but belongs to Brussels because it's always an agency of the European Union. So in reality, there is where then Europe can decide also to issue or enact a new directive or new regulation that might differ from US, might differ from UK. So there is no more a coordination policy. Everyone is going in its own direction. But in some directions, like the regulation of crypto assets, that is quite similar between UK and Europe. But it's very different in the US. Why they do this? I mean, this kind of different approaches, what is the main result of this change in approach?
I guess each jurisdiction wants to have their currency dominating the field.
Yes, I mean, if we speak about money, now if there will be also a war, in general terms, everything will be based on who controls this flux of money. And so, in the case of the US, they enacted the Genius Act, and so now stable coins are prominent in the US. And in case I told you even last week, majority of stable coins in the world, like 99%, are denominated in US dollar. This is one aspect. But then there is another aspect that essentially is competition. This is the main point, that essentially now, if there is a rise of unilateralism in this debate, there is more a concern on being competitive. If I am more competitive, I can attract more investors to the market, to my market. If I am less competitive, I cannot. In this moment, in the IPO and in capital markets, US is prevalent. So in reality, this deregulation process is paying off to the US in this moment. There are people that they claim that this is only a temporary effect, cannot last forever, and is something that you can gain a quick result today, but you damage the financial system of tomorrow. This is something that has still to be seen. Europe has decided to adopt this approach with the UK and European Union, so we believe that actually this is damaging the financial system in the future. We don't go in deregulation, we go in simplification to try to be competitive. But it's just a policy decision. Could have been done on deregulation. some people also they claim that in Europe it's not a full simplification, but it's speaking about simplification and then actually making it possible through deregulation. So it's like a sort of hiding what you are doing. This is something that, I mean, still is not well known. But I'm saying that this is why today competition matters. Competition in the market. So, for example, in the UK, there was in 2021 a reform of capital markets where they tried to push SPACs, but they failed. They tried to push dual class shares and listings, but they failed. So, in reality, there was never, the main problem is this: if you don't adopt a full model that is a model without a lot of regulation, investors, they will not perceive it in a good way. So today there is this kind of forum shopping. If there is competition between nations, there is also more forum shopping. So in reality, if you are an investor or you are an issuer and you are the one that you have the money at the end of the day, you will not allocate that capital to a country that is not competitive or to a country that is obliging you to follow many rules. You will go to a country like the US where everything is simpler in this moment. And so everyone is going there. But if everyone is going there is more liquidity. So if there is more liquidity into the market, there is more appeal to investors. This is why it's difficult to win this game by having both objectives, the systemic risk objective that we don't want to spread systemic risk and we don't want that maybe the failure of one institution is propagating to other institutions. So we try to have a macroeconomic view, but at the same time this microeconomic view also matters because you need to give to investors and issuers the possibility to come to your own jurisdiction. Make sense? Any question? So I think, I mean, if you want, we can take a break. And after the break, we go to examine the Financial Conduct Authority. So that we have finished the set of slides of last week, and now we go in the one of today, and we wrap up essentially all the general idea. 10-15 minutes. Okay, thank you.
Quelli che dobbiamo andare alle 20
Sì.
usciamo ora,
Sì,
perché
sì,
poi
sì.
durante la lezione
Sì,
come
tanto
siamo
sono...
sei, è uscito.
Sì, non c'è problema.
Anche perché durante la lezione
Yes. No, it's different. It's not the IPO. There is the IPO, direct listing and SPACs. 3 different ways to get listed. Different. They are all different. Yes. Dopo. Per cosa? Ah, quello è buono. Sì, no, quello è buono. Fammi sapere com'è. Ciao. good. You?
Doing fine. Is there any, we're going to discuss the Financial Conduct Authority. And is there any problem if I go to the event of the Re Suisse?
Ah, yes, go. Yes, also Sergio was going.
Sergio, Chiara, Pierre, and Lev, I think they're
Yeah,
going.
yeah, it's fine.
Perfect.
In any case, it's nothing. The thing bigger I discussed now.
And the readings, they're very clear about the whole history of the
Yeah,
Financial
exactly.
Conduct Authority. Do you think I want to buy a book for this class? For each class, I want to buy a book, and I was seeing the book of Elise Ferran of Principles of Corporate Finance. Is that a good book for this class?
But it's more corporate finance.
It's more corporate. Because I really enjoyed his first chapter.
Yes,
He's really
she's
good.
good. Yes.
But for this class, would you recommend a specific book? Like
This class. No, because there is a book about securities laws in the US.
Mm-hmm.
So reality, I mean, no, there is not one in particular. We just provide you with the readings, and with that you can pass.
Yes, but I
If there is one,
bought a book in these days and realized that I prefer having the book in my hands. But just to have it.
can be, because also we said in the securities regulation is more in the US. Here is more investor protection and company law, English company law. So by knowing English company law here, you know securities laws in the UK. That is how it works.
So I think the book of Principles of Corporate Finance could be a good
Yes,
instrument.
yes, because that is giving you also comparative view.
Yes, and it has a good price. It's
Yes.
relatively cheap.
Yes, exactly.
We go.
Really?
You're coming, right?
Sword?
To the event.
Why sword?
Yeah, Sergio wanna go. To the math class. Yeah, we don't wanna interrupt. Just go to that.
Stay at least 1 hour. Less than 1.
No. It's like but
Yeah. Now that you're
No, not with the whole group. I take the advantage. And that's it. They can give us a lecture after this. It's recorded, right?
So, yes.
Okay, we have the Swiss re-event.
Yes, yes, it's fine, it's fine.
you.
No, it's better. That one is much more important. I mean, this one is
you send it, so.
it's good. It's good, it's good.
Next week?
Next week.
M&A tomorrow?
No, because once you say this Swiss, I remember speak about this Swiss bath.
the restaurant.
Yes, but I don't know why I think of this. But I think, yeah, even that
It's
is good.
too early for
But even that is good.
You're
You
ready
should-
tomorrow with M&A?
Yes, yes.
Okay, see you tomorrow.
Tomorrow.
Thank you. This is good.
So I think I will start again because some of you, some students, they went to another event that was an event that we sponsored with Rosa Lastra, and so they were selected in this event. So I think we can start again. So the slides that I'm going to present, in reality you will see there are different things that is for you, for your knowledge, and also good things that you can use as a reference to study, you can use for the essay. So it's mainly for you. I will not go in much details, but I will focus on specific things that probably, you don't know, and so you have more context. The other things, are quite standard, so are things for you to reflect about and that you can use even if you want to quote something on the essay, you can write PowerPoint week number 3. So even to clarify, also for the essay, you can copy and paste some expression that you like, as far as then you write PowerPoint number 3, week number 3. There is not a standardized way to cite PowerPoints. So here, it's telling you something that I already told you, so that in the banking and securities regulation, actually in the UK, has developed in time. I already gave you the line before, that here everything is about investor protection. We don't have an idea in the UK to discipline IPO, or is not the main purpose. The main purpose here is to protect investors with investor protections. And there is a body of the law. Here the slide is telling you that there are different bodies of the law. One is company law. For securities laws, that we might refer to securities laws, but would be incorrect to speak about securities laws in the UK. It does not really exist, because everything is about company law. And everything is about even banking regulation. So the title of the slide that is telling you securities regulation in the UK, the FCA and its operating environment, we need to speak a bit about the FCA, how the FCA born, and then we need to speak a little bit about the operating environment of the FCA with the Twin Peaks model. And securities regulation I already addressed before, so in reality it's about company law in the UK, the majority of provisions, and some guidance or some rules designed by the Financial Conduct Authority. So for example, in a practical term, if in this country I want to perform an IPO, I need to write a prospectus. This prospectus will be then certified and approved by the Financial Conduct Authority, by a department that is only operating on primary markets, secondary markets, and is approving the prospectus. But the way how they approve it, the integration of disclosure, how the system of disclosure work is the same in the US, is the same here. So in reality the principle does not change. You need to disclose information in the prospectus. This is not different. Now, because we speak about securities regulation, that is a set of norms that belongs to a major group. This major group is financial regulation. Within financial regulation we have rules that actually they address different kind of operators and sectors. One is the banking sectors, so financial regulation belongs to banking regulation. So one subset of rules within financial regulation is banking regulation that is going to govern banks. So what banks they do. Banks actually, is not this the course, because some of you maybe took a regulation of financial markets. There you studied what is a bank, what is banking regulation. Here we study securities, so in reality securities markets. Securities markets here generate information asymmetries. We already said before. So information asymmetries because if I am the manager of the corporation, I am an insider of the firm, and then there is outsider of the firm, that is the public investor, that always knows less than the insider. For this, because there is information asymmetry, there is the need to design investor protection. So the main purpose of a body of rules designed to govern securities markets, especially in the UK, will be to provide investor protection, to assure market efficiency, and to promote market integrity. So the behavior of market participants, to avoid that there are opportunistic behaviors of the managers, that they are mis-selling maybe shares, that they are perpetrating fraud, they are committing market abuse, or maybe in other cases insider dealing. In fact, if you remember last week, that man spoke about insider dealing briefly. Once in reality you are in possess of an information that is private, and you use this information for your advantage in order to profit from the trade. But this behavior in reality in financial history is not uncommon, and is something that in reality was never illegal. It became illegal in the US in the 1929. In that crash of Wall Street, there was the first legislation about insider dealing. And then insider dealing actually was regulated within the Securities and Exchange Act 1934. Then in the UK, after a long time, so if you have a look, you want to research about it, insider dealing legislation in the UK is quite recent. It's in the 1960s, in the 1970s, so it's not something that we are speaking about a legislation of 100 years ago. And it's because actually fraud in securities and in shares was covered in part by Companies Act. So the Companies Act was covering, and the provisions that are related to the regulation of companies in the UK was already covering this aspect. But regulation in general terms, serve a public good. So in reality, in regulation, this is something that then we will see more once we examine today the Twin Peaks model, is based on two kind of supervisory approach. So every time that we speak about regulation, we speak about the enactment of rules, and then there is supervision, that is the implementation of rules. The implementation. So supervision, implementation. Regulation, the enactment of rules. I, for example, am the UK lawmaker, English lawmaker, and in that case I enact a rule that can be one set of rules that will belong to financial regulation. Within financial regulation, we need to see whether it's banking regulation that belongs to the regulation of banks, or securities regulation belongs to the regulation of securities markets. So it depends on, or can even be insurance markets, so that is another set of rules, always belong to financial regulation. And in fact, this kind of division is also in Europe, because Europe, the European Union, at the international level, you have EIOPA for insurance, you have the banking authority for banks and for the banking sector, and then for the securities markets you have ESMA, European Securities and Markets Authority. So this kind of philosophical approach has been endorsed in Europe, is endorsed in the UK, is the same, essentially. UK in 1972, we said, was member of the European Union, so they influence with this vision also the structuring of the European financial architecture. Make sense? Okay. Then this slide relates more to the fact that if there is a crisis, so in reality every time there is a crisis, there is a regulation that is enacted. And this is quite important, because once we speak about the birth of the Twin Peaks model in the UK, with the Financial Conduct Authority and Prudential Regulation Authority, in reality that is a derivation of what happened with the Financial Services Authority. So because the Financial Services Authority collapsed historically and failed in supervising Northern Rock, for this reason then the government started to think about a new regulatory architecture for the UK. And so this new regulatory architecture today is in the Twin Peaks model, with the Financial Conduct Authority and Prudential Regulation Authority, so two different peaks. And that is the environment where the Financial Conduct Authority operates within a Twin Peaks model, while before there was only one single regulator, that was the Financial Services Authority. Now, why the Financial Services Authority failed, and what happened also before the Financial Services Authority. So the Financial Services Authority is the one that failed on the supervision of Northern Rock. But before that time, who was the supervisor of banks, for example? Before the time of the Financial Services Authority. Here you see why it failed. So you see why the Financial Services Authority failed. Because we said even before, too many objectives, a lot of confusion, one single regulator, multiple objectives, weak prioritization in terms of stress. Once there was a stress of the market and Northern Rock was going to fail, this failure was not in reality mitigated and was not even avoided. So Northern Rock had to fail. But before that time, what happened before the Financial Services Authority? Who was the supervisor in charge? Yes, the Bank of England. So before, in reality, in the banking sector, the main supervisor, natural, logical supervisor is the central bank. So usually it's the central bank that is going to supervise from a prudential, rational banks. And it's also the natural supervisor of banks. But then, at that moment in time, that it was like 1990s, something happened. Do you remember something about BCCI? No? Yes, me too, because in reality, I mean, I was a child, I mean, I was not. But generally, I mean, BCCI was a company, and here I don't know if I can show you, was a bank. Maybe yeah, this one. So this is BCCI, this is the time, and actually they dedicated a cover to BCCI saying that it's the bank of crooks and criminals. So in reality BCCI was a bank that was set up and operating in Luxembourg, but then the main center of transaction and the operation was in London. And so why they did this? Because in Luxembourg there were less rules, less regulation than in London. But if then all the main transactions are carried out in London, that is how we can avoid supervision. In London they had only a small office, and this office actually, during 25 years of operation of BCCI in London, the Bank of England never investigated what was happening there. What was happening is that BCCI was a bank that was operating internationally, was operating cross-border, and actually was the bank of Pablo Escobar and other criminals. So in reality they were money laundering money with BCCI network. And BCCI was more towards the model of a Muslim bank. So in reality, I mean, it was an Islamic bank. It was an Islamic bank in Asia, and actually many Muslims, even in London, they deposited money because they were thinking that they were in compliance with Sharia law. And so in this way they could attract even more capital. But then once this bank failed, actually all those money that were deposited by Muslims and so on, they were lost, because actually there were not protection in place, and there was not even this idea of consolidated supervision. So in reality, at the time, regulators, they were not in reality speaking to each other. They were independent in each country. And that is also the reason why for 25 years even BCCI could operate, because there was not a network of communication that they could understand what was happening in the headquarters, what was happening in the subsidiaries and in branches, simple offices. In fact, here was a branch in London. Then, with the Basel Committee on Banking Supervision, that is another standard setter for banking sector, they started to design all rules related to BCCI, so related in reality to this concept of consolidated supervision, to say if you have the headquarter in one state, that state will be in charge of supervision for the headquarter. If you have a branch in another state, still the supervision belongs to the home state, and then if there is a branch, that belongs the supervision to the host state. But this is something that, is done through this role of coordinated supervision, and this document that is a recommendation of the Basel Committee on Banking Supervision under the auspices of the Bank for International Settlement. So that is why, from a supervision that was concentrated in the UK in the hands of the central bank, the Bank of England, the government decided that because the Bank of England was unable to supervise BCCI, we needed to design a new regulator, the Financial Services Authority. But the Financial Services Authority, in reality, and here was the slide, in reality failed. And so failed because there were too many objectives, failed because one single regulator cannot be in charge of the banking sector and securities markets and everything else. And so since that moment they started to rethink again the financial system. So this is something that can show you regulation in general is always in delay. It's coming after a crisis. If there is a crisis like BCCI, they start to invent the Financial Services Authority. The Financial Services Authority is going to fail with Northern Rock, and so they start to design a new model. And this is something that will always happen. Will happen in delay, not beforehand. But then, after this moment, after the failure of the Financial Services Authority, we have the Twin Peaks model. In the Twin Peaks model, we have two peaks, that one is the Financial Conduct Authority, and the other is the Prudential Regulation Authority. So in some way, that supervision of the banking system that was naturally within the hands of the central bank of the Bank of England before, came back to the Bank of England through the Prudential Regulation Authority, because the Prudential Regulation Authority sits within the Bank of England. And so in this way there is a connection also in communication of news that are between the Prudential Regulation Authority, the Bank of England, and then on the other side the Financial Conduct Authority, that will be more dedicated to the discipline of securities markets, market efficiency, market integrity. This is within Financial Conduct Authority. Even today we are speaking about a reform in this country, that is the UK crypto asset reform. This UK crypto asset reform is implemented, supervised by the Financial Conduct Authority. Crypto assets are tokens. These tokens, they can also take the form of securities, but still is under the Financial Conduct Authority, not the Prudential Regulation Authority. Then there might be overlaps, and this is something that also the slides are telling you. Before 2008, that is the year of the global financial crisis, in this country, and this is something that I told you last week, we had a system of principle-based regulation. But this principle of this regulation based on principles, if you remember, there was a slide last week that told you, does not work with in a system where there are people that they don't have principles. And so, in reality, the main point here is always to decide which approach in regulation you want to adopt. An approach that is more about the enactment of rules that are law, they are hard law, or something that is more soft and is based on principle. If we see the UK listing reform in this country that was very recent, In reality, they adopt a mixed approach where there are some rules specific with specific parameters how you need to list a company today, but also some principles that you need to follow. Among those principles, one of them is the principle of disclosure. So that is a principle that will always be applicable because, of course, we said in securities disclosure is key in order to avoid investor fraud and market abuse, essentially. Make sense? Okay. But those at the end, I mean, are also the arguments why the system of principle-based regulation does not work. Supervisory intensity, credible enforcement, regulatory skepticism. That actually, I mean, is about the fact that if you design rules, and these rules in reality are based on principles that are too generic, people, they can always have interpretation. And so that is why we design today in systems of regulation that are more into enactment of rules that are more hard and not subject to interpretation. The failure of supervision I already told you, I mean post-crisis and what happened. And we can go directly, I think, to the slide that is just a summary. I mean, this is a summary that is relating to what happened at the level of the global financial crisis and the approach of the UK afterwards. So once there was the global financial crisis, there were different reforms in this country, and those are the main acts that were enacted in the form of regulation. Hard law without interpretation. Banking Act 2009, and that is one of the main points. How many of you took regulation of financial markets? Okay, very few. Okay, so I need to explain. So essentially, the Banking Act is an act that is more devoted, especially post-global financial crisis, to develop a system of regulation that they relate to resolution regimes. So they think that if there is a bank that is going to fail, we need to avoid this failure. So if there is a bank likely to fail, we need to save the bank. And to save the bank, we need to design resolution regimes. These resolution regimes were in reality developed through recommendations. These recommendations were issued by the Financial Stability Board. So you have what is called the key attributes, and the key attributes, the first one was 2011, and then there was a revision in 2014. You can find those in Google. If you go on Google, you find resolution regimes, key attributes. Within this document that are recommendations, so it's an example of soft law because the Financial Stability Board is a standard setter in the international financial architecture. The financial setter, the standard setter, that is the Financial Stability Board, has enacted one specific set of recommendations that are key attributes and resolution regimes. These resolution regimes are telling to states and members of the Financial Stability Board that they should adopt in their jurisdiction specific laws in order to design resolution regimes. What does it mean? Anyone has an idea about resolution regimes?
It's the process authorities should consider in the process of helping a bank when it has liquidity problems.
Yes. And what are those?
Or insolvency. Well, it's related, but...
Yes, because in a bank, I mean, there is a thin line between liquidity problem and insolvency problem. And that, I mean, if you think about a balance sheet test, if I don't have money to repay once the full due debt, in that moment I might have more a liquidity problem. But a liquidity problem, because I don't have cash today, I might have in 3 months, can be transformed very easily into an insolvency problem, where in reality the value of my assets deteriorate, and so the value of the assets is far below the level of liabilities. In that case, it's more insolvency problem. And to draw this line is very difficult. So a resolution authority, in this case will be the Prudential Regulation Authority with the Bank of England, the resolution authority should step in in order to make an active engagement. This active engagement in reality is designed in these key attributes. So the key attributes are telling you that, for example, if there is a bank that is failing or likely to fail, you need to sell maybe part of the business to a bridge bank. So the bridge bank is one of the resolution tools. So what is a resolution tool? It is a crisis management mechanism that is developed as an official response. So an official response because it's from public authorities, and in fact the resolution authorities are public authorities, the Bank of England and the Prudential Regulation Authority, that are going to actually design, to copy and paste what is in the recommendation designed by the Financial Stability Board. Is this clear in your mind a bit or not? Yes? So international level Financial Stability Board key attributes, then the UK Banking Act is going to design, to copy and paste those recommendations. So it means those recommendations without the Banking Act, they don't have effect in the UK. So in the UK we have the Banking Act. Bridge Bank is one, but one of the main resolution tools is bail-in. Bail-in is one of the resolution tools. Because what is a bailout?
Like the state pays for the debts of the bank.
Yes, once in reality the state is bailing out a bank, so it means it's injecting liquidity. The bank is lacking liquidity, and so through the injection of liquidity, the bank can survive. Without that injection, cannot be possible. But is something that is taken from taxpayers' money. So that at the time of the global financial crisis, once Lehman was going to fail, the US government could have bailed out Lehman, but they didn't, because they were thinking that this in reality was not a good behavior, because could generate moral hazard, could generate economic behavior through which every time that a bank is in trouble, it's going to use taxpayers' money in order to survive. So it's something that in reality is against our own interest, because we all pay taxes, and then we need to bail out the mistakes of the management of a bank, and we are not responsible for that management. So that is the rationale behind. But because the US decided not to save Lehman Brothers, then there was a systemic crisis. And so for this reason, already at the moment of Lehman, the US started to think to bail out AG, that was the insurance provider that was selling in a massive scale CDS, credit default swaps. Once the CDS, in reality, they were triggered by the credit event that was the failure of the CDOs, the collateralized debt obligations. At that moment in time, many people that they own, that they have bought CDS, they came to the door of AG asking for compensation. But AG could not, in reality, give to everyone. Didn't have enough liquidity. And so they had an injection of liquidity through US government, using taxpayers' money, contextually to the failure of Lehman Brothers. So they saw the negative effect of Lehman Brothers, and then they immediately saved AG. And in this way, I mean, AG could not collapse, but that is a bailout. So it's using other people's money, taxpayers' money, in order to save a public institution. And that is something that is not in favor. I mean, the moment of the Banking Act is the moment where they started to think that bailout is not a good approach. And so the resolution regimes, among which there is bail-in, is the new tool. So bail-in is the tool through which, in reality, you can save a bank by in reality cancelling the debt of the bank or converting that debt into equity. So if you convert the debt, the liability of the bank, into equity, you are recapitalizing the bank indirectly. And that is a way, in reality, to say to the bank, because in reality your management did some mistakes, rather than using taxpayers' money, let's use your own liabilities. So let's try to internalize the cost of the failure within the bank itself. So that is the main rationale of bail-in. But bail-in, for example, once was applied in Europe. The first country that applied bail-in in Europe was Cyprus. And Cyprus, in reality, in that case, they use, this is another conception of bail-in, you can also use the money of depositors to recapitalize the bank. In fact, we said that depositors, they have insurance, and there is deposit insurance. Deposit insurance is a crisis management mechanism as an official form of crisis management mechanism, but this form of crisis management mechanism in reality can has a limit. So usually in Europe is 100,000 euros. That is the limit where you will not be insured above 100,000 euros. So for example, if you have money deposited in the bank for a value that is beyond 100,000 euros, you will lose your money if the bank where you deposited the money is going to fail, because the bank can repossess that money. Is clear? So that is the main rationale, and in fact there is a video, so that in very few minutes I can show you what I explained you in more, so that can stick maybe to your mind. Do you know how it's working? maybe, maybe. Let me see. Let's see. No. No, maybe here. It's completely, I don't know. But in any case, if you want, this is Richard Wolff explaining bail-in. You can watch. It's very good video, because he's telling you this difference between bail-in and bail-out.
That is, they invest money.
Okay, let's put a bit less.
Bail-ins. Let me explain quickly what that is. Banks have a hard time because they often make terrible mistakes. That is, they invest money by loaning it out to people and businesses who can't pay it back. When that happens, the bank is supposed to use the capital of the people who got together to create the bank, the capital of shareholders if they sell shares to the public, to deal with their mistakes, to fix the damage of folks they lent to who can't pay it back. It's the job of the bank not to lend to people who can't pay it back. So when they don't get repaid, like happened on a massive scale in 2008 and 9, you know what the banks do. They don't want to use up their own money, so they go to the government to get a bailout. The problem is the politicians who give banks big bailouts, as they did, get to be hated by the mass of people who understand very well what's going on. That private banks, to make private money, want the government to bail them out, and they don't want to have to do it. But the banks don't want to do it. So here's what the banks and the politicians got together. They found another sucker. You know who it is? The depositor. It turns out that the laws have been rewritten, starting with a bank in Cyprus that went belly up a few years ago, to allow banks, when they can't recover money they lent and should not have lent, they don't now have to go to the government to get a bailout. They can get a bail-in. You know what that is? Taking money from the depositors who put money in the bank and simply taking it to recoup their own capital that they can't get back from the people they lent to. Is it legal to have a bail-in, to take the money of the depositor and not give it back to them? The answer is yes. In many countries, including the United States, the laws now allow a bail-in. Should that upset you? Uh-huh.
So basically, this video is telling you what we said until now. It's telling you that it's possible to recoup that money, but it's possible because even, I think I told you last week, in this country, like many other countries, once you deposit money in a bank, that money is not more your money. That are the money of the banker to do whatever he please. And this is written in a major case law, in English law. And this is something that is law, because this is a common law country. In other countries it's stated in statutory law. So every time that you deposit money in a bank are not your money. If you have money until, for example, in this country, £80,000, this is covered by insurance. If it is more and the bank is going to fail, one option that the bank has is to recoup the money through your deposits. And so this is legal. So this is something that is not under dispute. And it's something that, I mean, for this reason, many people, they don't think about it, but it's important. Yes?
And is it the money of the depositors, or is it the money of certain more high-level investors of the bank?
No, it's best, even me, you, we can be inside. As far as we have more than the limit of deposit insurance. If the limit is more, if we have more in the bank, that can be repossessed. But if those money that we have more, so we have in the bank only up to 100,000 euros, and all the other 500,000 euros are invested maybe in a mutual fund, are invested maybe in properties, that will not be touched, essentially. So only the liquidity that you deposited in the bank. Of course, major credit institutions, usually they don't tend to fail, but can happen. So even Credit Suisse failed in 2023. So in reality, we don't know. The banking system is not secure 100%. But it's true that there are different kind of legislations, like this Banking Act, where once implemented in a country, it's difficult that a solution is not found. So usually they try to avoid, because in reality, if you take money of the depositor, there might be not a big consensus in the population and taxpayers. For this reason, they try to avoid that. I mean, the solution tools are different. There is the bridge bank, there is the bail-in. And the bail-in, I mean, I told you the main form is to write off liabilities or to convert liabilities of the bank into equity. So from a debt holder, you become an equity holder. But that is also the problem of bail-in, because if, for example, we think about the bank in Cyprus, Bank of Cyprus in reality had different liabilities towards different Russian individuals that they were a bit dodgy, or at least they were thinking they were dodgy. So there was a sort of risk that at the end of the day, reputational risk, that if that debtor today becomes the equity owner of the bank, he possesses the bank, and so there is a reputational issue there. To avoid that reputational issue in practice, Bank of Cyprus decided to list on the London Stock Exchange, and once you are listed and your securities are listed through the London Stock Exchange, there is a high level of disclosure. So you know exactly who is the main shareholder, for example. And that is the reason why, because there is a check, and the check we spoke about in securities laws is carried out by the investment banker, it's very unlikely that the main shareholder now is dodgy, because otherwise could not be there and the company could not be listed on the London Stock Exchange. This is how, in any case, the Bank of Cyprus could avoid that reputational issue. And today, if you go in Cyprus, everywhere there is Bank of Cyprus. I mean, it's the only one of the two that survived the financial crisis at the moment. All clear? Then, so Banking Act for the banking sector. Then we had another instrument of legislative response, that is the Financial Services Act 2013, and that is the moment where actually we moved everything into this Twin Peaks model between the Financial Conduct Authority and the Prudential Regulation Authority. Then the Financial Services and Markets Act 2000, as amended, the last amendment was 2023, is one of the main acts that they relate to the discipline of securities markets in the UK. So you find regulated activities, there is a specific instrument of regulation that is the regulatory order, and this regulatory order has a list of regulated activities in the UK. For example, one of the last regulated activities in the UK is crypto assets. So now crypto assets, the regulatory perimeter of the UK is designed through the Financial Services and Markets Act 2000, and the crypto assets and the regulatory perimeter has been extended to include crypto assets in this moment. So today, if you are a crypto firm offering crypto services or instruments in the UK, you must be registered with the Financial Conduct Authority, and you must have and obtain an authorization from the Financial Conduct Authority. So another level of supervision is within authorization, because without authorization you cannot offer services. If you are a mutual fund, you need to be registered with the Financial Conduct Authority. If you are a pension fund, the same. So this kind of authorization are delivered by a department of the Financial Conduct Authority, that they look at the law and they see whether you respect those parameters. Among those parameters, there is a parameter of capitalization, because if, for example, you cannot pay out your investors, that is a major problem. And so to avoid that, you need to obtain an authorization that is indirectly a form of certification that you have a certain level of capital, not to fail, and to pay out investors. Make sense? Yes.
US is really pro-crypto and EU is more cautious, but what about the UK?
I mean, Bank of England, what I was mentioning was something in the past. So at the time of BCCI, Bank of England failed in supervising BCCI. This is the reason why they created the Financial Services Authority. Are two different things. So that was only related to the failure of supervision of the Bank of England in relation to BCCI. Then they created the Financial Services Authority. The Financial Services Authority failed the supervision of Northern Rock, and then they created the Financial Conduct Authority. For now, the Financial Conduct Authority didn't fail in supervision, any major failure. Makes sense?
What about crypto?
Crypto, yes, is something that also Douglas, in this class, you have a class with Douglas only with this, but essentially the position is different because we have on one side the US, that they enacted specific laws in relation to crypto assets. Among crypto assets, one of the main is stablecoins, and that is the Genius Act in the US. Here there is something that is still not law, but will become law and implemented in 2027, possibly, or the end of 2026, and is the UK crypto law reform in crypto assets. So that is something that actually we are writing a chapter and commenting on the reform with Professor Lastra, me and her, and we say that actually the UK is no more close to the US, it's going closer to the European Union with MiCA, with the regulation in crypto asset activities. So that regulation in Europe is more similar to the UK. So the main point is that they want to have an approach that is in micro-prudential supervision. So they want to supervise the single entity. They want to supervise the crypto firm that is offering crypto services in Europe or in the UK. That is their idea. So what does it mean? That if there is a micro-prudential supervision approach, they are saying maybe to the crypto firm, like today in this country, you need to have an authorization of the Financial Conduct Authority. You need to have a certain level of capital requirements. You need to have a certain level of liquidity requirements and so on. But that is only done to prevent the possible failure of one single entity. So it has a micro-prudential rationale, while in reality we need also to look at the macro-prudential picture. And what I claim, in fact, is that both the UK and Europe, they lack this macro-prudential approach. So if there is a systemic effect, the systemic effect actually is not prevented, mitigated, or regulated in today's terms. Make sense? Then here, yes, is the summary of the Banking Act on the special resolution regimes that we already said. So, if there is any question on resolution regime, but I don't think so. We said that one of the main is bail-in. This was a key policy shift after the 2008 with the rejection of bailout. This is something that we already said, I already explained to you. So the special resolution regime is the new rule, the new approach. Bailout is the past. But also, to answer your question that you might have, yes, even today there might be a bailout. It's not forbidden, but it's not the preference. That is the point. So we need first to go through the special resolution regime, and then in case to have even in tandem a bailout. Then among the crisis management mechanism, as official response, there is also another one that is the lender of last resort. So you need to see all these things together. There is also the lender of last resort that is a function performed by central banks that they can inject liquidity to the bank that is going to fail. But the lender of last resort is under discretion. So it's possible also that the central bank is not given the lender of last resort. This is the reason why we have more than one. So we have deposit insurance as a crisis management mechanism, we have a special resolution regime, and we have also on the side bailout that is still there, using taxpayers' money, and within crisis management mechanism we have also the lender of last resort. So you might even have a situation of a bank that is going to fail, that is going to get liquidity from each of these instruments. Make sense? Yes, this is then the act that dismantled the Financial Services Act 2013, dismantled the Financial Services Authority as a single regulator for all the things that we said before: too many objectives, multiple objectives, confusion, lack of supervision. And so now we have this twin peaks model. So we have conduct regulation that is supervised, enacted and performed by the Financial Conduct Authority, and then we have prudential regulation that is the supervision of prudential requirements, and that is done by the Prudential Regulation Authority. The Prudential Regulation Authority is also in charge of supervising insurance major financial institutions. So these major financial institutions, then they will receive some rules and supervision from the Prudential Regulation Authority and also from the Financial Conduct Authority. So there is a dual mandate. So that is the main criticality, that there are still areas where this supervision can overlap. But it's better to have a double supervision than to have nothing, or to have something that is more confusing. This is why the Twin Peaks model, they believe, is a system that will succeed because there is more order. Every regulator supervisor has its own task, and its own mandate. And then there are dual supervision. There is also dual supervision for major financial institutions, because those are major financial institutions. It means that the possible collapse of a major financial institution can generate systemic effect. If the Prudential Regulation Authority is in charge of macro-prudential supervision, this is why the Prudential Regulation Authority has to supervise the major financial institution. But still, because the major financial institution may be the deal with securities markets, that is the reason why the Financial Conduct Authority is going to supervise also that aspect. Make sense? Then the Financial Conduct Authority is also especially delineating conduct rules. So, conduct of business rules, how a firm, how a company should be run, is delineated in specific documents of the Financial Conduct Authority. And the same standard of norms, provisions of conduct rules is also addressing bankers. So, for example, it's true that banks are under the supervision of the Prudential Regulation Authority, but still in terms of how they need to act in the day-to-day operation of the bank, that is under rules that are designed by the Financial Conduct Authority. Is clear or not? So they have a dual mandate. There might be cases where a firm is supervised by both, and the cases where it's supervised by one. But they still have this rationale of micro and macro prudential supervision. So they try to avoid systemic crisis, and they try to supervise the single entity. In which way, if I am a crypto firm, I need authorization. I need to go to the Financial Conduct Authority. Without authorization, I cannot operate in the UK. And the same is true for banks. Now, banks is more authorization from the Prudential Regulation Authority. But if there is a case that is sitting in between, where is a major financial institution, there they should cooperate in discussion between the Financial Conduct Authority and Prudential Regulation Authority. The Prudential Regulation Authority then sit within the Bank of England, and that is done because if there is a failing institution, then the Prudential Regulation Authority not only is in charge of applying the special resolution regimes, but also to advert immediately the Bank of England that might activate the lender of last resort function. This is why they sit together. All clear? Yes? And here is also, very visual. Before, one single supervisor and regulator, then you have two, Prudential Regulation Authority, Financial Conduct Authority, that they were established in 2013. The role of the Bank of England we said already, the lender of last resort, the fact that there is a Financial Policy Committee that is part of the Bank of England exercise macro-prudential oversight. So also the Financial Policy Committee will communicate with the Prudential Regulation Authority. So that is why they sit together. And so this is an expansion of central banking authority and might raise constitutional accountability questions. In fact, there is always a question of accountability of the central bank, and the central bank has to respond to Treasury and Parliament for what they do, how they manage a crisis. For example, even Silicon Valley Bank failed in the US, but then there was a subsidiary here in the UK. The subsidiary, in reality, at the start was put into liquidation, but then they revert the liquidation with a special resolution regime, with the application of a special resolution regime. And so they, in reality, decided to sell the subsidiary of Silicon Valley Bank to HSBC. And this was done by the Bank of England, Prudential Regulation Authority, and Treasury. They acted together and they sold, avoiding in this way systemic risk, saving the bank because the operation of Silicon Valley Bank here in this country still they could operate, and they were sold in the very short time, in the weekend. once there is the closure of the market, and then on Monday there is the opening of the market. On Monday the selling off was already implemented. HSBC bought for £1 Silicon Valley Bank, 2023. So all these kind of even examples that I draw to the slide, you can use then in your essay, can be part of your essay essentially. Yes, let's go, now more a little bit in the regulation of securities markets. This regulation, we already spoke about it because we said about company law, so there is an intersection of law as a source of law, statutory law, company law, English company law in the UK. There is public enforcement because that is done and performed by the Financial Conduct Authority. So if there is a case of insider dealing, a case of market abuse, this is enforced, investigated and supervised by the Financial Conduct Authority. There is a department. I was working in that department, in the Markets Oversight, it was called. Enforcement and Markets Oversight, EMO. And that is a department that is still there and is actually, in charge of public enforcement. And to investigate cases, the curiosity, because I have a practical experience because I was working there, is that actually, the investigation is very long. While in our countries, in Italy, in Europe, or also your countries, the investigation will last for a short period of time, or the law is telling you that you cannot go beyond a certain period. Here, it depends. It depends on the case, and the Financial Conduct Authority has a lot of power. Within the EMO department of the Financial Conduct Authority, we have especially policemen and detectives that they sit there. Something a bit atypical if you are from civil law jurisdictions, because that kind of function will be performed by the police with the prosecutor, not with the consob, that is the equivalent of the Financial Conduct Authority in Italy. There are only people that actually, they don't investigate. The investigation is done by the police outside. In the case of the UK, also in the case of the Securities and Exchange Commission, it is done inside. So the same policemen, they sit within the same department, within the same regulator and supervisor. And then the case is brought on trial. So there is a criminal law case that is decided then in court. But still there are the same people of that department that they go in front of the judge to start the case. So that is the difference in approach, because those are specific agencies that are not the same in civil law jurisdictions. And so securities laws is this mix of private laws, company law, for example, public enforcement, and regulatory supervision. So supervision, we said, if I am the Financial Conduct Authority and I need, for example, to receive a crypto firm that wants to operate and offer services in the UK in crypto assets, that is something that needs authorization today. So without the authorization of the Financial Conduct Authority, you cannot operate. So that is a form of supervision. Authorization is one of the quintessential form of supervision, because we make sure that the rules that we design are implemented. Make sense? The concept then of securities laws in the UK, in reality, we said in company law in the UK there is a lot of focus on investor protection, but the terminology of securities, in reality securities is a terminology within the Company Law Act. And so there are also people that claim that securities laws in the US has been borrowed, this terminology of securities, by the UK, because was the terminology of the Companies Act. Then Financial Markets Act is the main act in relation to securities activities in the UK, and there you have also a specific instrument that is a regulation. That regulation of activities, it is in reality to be read in conjunction with the Financial Markets Act. The Financial Services and Markets Act is in reality designing the regulatory perimeter and is telling you with this other regulation what are the regulated activities in the UK. Crypto assets is one, maybe trading of securities is another, and so on. So even if you are a mutual fund in this country, you need authorization because you are in reality dealing with a regulated activity. And the list of regulated activity can be modified by the law. So that is something that can change. The power to extend the regulatory perimeter in this country is not the Financial Conduct Authority, it's the Treasury. So the Treasury has the power to extend the regulatory perimeter. The FCA will then enact specific rules for that regulatory activity, regulated activities. All good? Authorization, this is how works. So really, I mean, you need authorization requirements that relate to organizational competence, capital adequacy, we said already, governance and systems, fitness and propriety of management. So managers, sometimes they must be qualified. If I am a manager of an alternative fund, I will have less regulation in comparison to a mutual fund. Why? Why, for example, there are more rules on the managers that they sit maybe at the apex of a mutual fund and less at the managers of a hedge fund that is an alternative fund, an alternative fund. Why, in your view? No? But basically, I mean, it's the sophistication of investor. So usually, if you invest in a mutual fund, you can be yourself, and so you don't have a lot of knowledge. And so that is why there is investor protection. One form of investor protection is to, in reality, design specific rules for managers of a mutual fund. You need to pass certain certificates. For example, I'm in charge of designing some of those exams in the UK for managers that they need in reality to pass the exam, otherwise they cannot be qualified. And if then they are qualified, they can run the management firm. In this case, mutual fund, pension fund. Otherwise, if you are an hedge fund manager, you don't need that because your investors are qualified investors or very wealthy individuals. So in reality, they are people that they can take their own risk and they can afford the risk that they take. A retail investor, no. And mutual fund, you can have a retail investor because you can decide to open your account with a bank and have a bank deposit, or you can put the same money with a mutual fund. You can do it. But of course, there is usually, if you look at Fidelity, for example, one of the main mutual fund, there is a level of money that you need to deposit, otherwise you pay too much fees. So usually for a mutual fund, the minimum is £20,000, the minimum. In a bank, no, there is not, you can even open a bank account with £1-2. So this is one of the differences. But because even the rationale is different. In a mutual fund, you do this to invest. In the other, you do in reality just to deposit your money and to use your money for transaction, payment transaction. Makes sense, no? Then disclosure, we said many times. I think today, disclosure is one of the cornerstones of UK securities regulation, the same thing in the US. So the slides in reality are just a summary of what we said until now. The Financial Services and Markets Act, we said many times what is going to do, that is the main parameter of reference for regulated activities, and that is the main point. Yes, and this is something about the mandate for the Financial Conduct Authority. So we said that there are different kind of mandates for different regulators. In the case of the Financial Conduct Authority, in reality is to assure market integrity and market efficiency. So it means also to supervise market abuse, insider dealing, and the selling of securities to the market. Now, here you have, I think in your readings, there is a reading about Ferran. The Ferran argues that this mandate reflects a more interventionist, enforcement-oriented philosophy in relation to wholesale securities markets and corporate financial instruments. So, in reality, she believes that this is something more related to investor protection for the market and for qualified investors, and more related to supervise the criminal law offenses that are market abuse, insider dealing, something that, I mean, these are things that if you want you can use more for your essay, because at the end of the day, the important point from a practical point of view is that you know that there are different mandates. These mandates are for different regulators. In the case of the Financial Conduct Authority, is to design conduct rules. In the case of the Prudential Regulation Authority, is to supervise the financial system as a whole, and to, in reality, supervise single entities in specific banks, insurance companies, and major financial institutions. Are different mandates. To these mandates, we have a new mandate, we said before, that is competition. Competition is the new mandate by the Financial Services Markets Act 2023. Let me see. Investment banks, yes, this is something that if you are interested, we will have an entire course this summer, always with Douglas, on investment banks, private equity and venture capital. So it's a new course, so if you're interested, this is not the course for investment banks, but we will speak more about investment banks in 5 weeks this summer. But even investment banks are a different type of banks, because investment banks are those that we said, they help issuer in IPO. So that is something completely different from a bank. And there we will design again what is a bank, what is an investment bank, how at the start those two were separated as a function. Today they are always more closer. So today you can also open, JP Morgan is an investment bank, but it's also a retail bank. So you can even open an account with JP Morgan. And so JP Morgan is in between investment banking and commercial banking. It's more a model of universal banking. So that are all forms of evolution of financial institutions that they can also trigger questions on regulation, which regulation we should apply, regulation that only applies to banks for commercial banks, or also rules that apply more for investment banking, and so the marketing of securities, so securities regulation. So all these rules, a set of rules, this is what I want to say with the slides, they can in reality mix together or overlap together. So although you study here sometimes financial regulation, then you study securities regulation and so on, then all this they need to see together, I mean, they are together. And then the lack of coordination challenge. In reality, I mean, and this is, we spoke before, between the Financial Conduct Authority and Prudential Regulation Authority, there might be a challenge of coordination between the two. Because some forms, like major financial institutions, they might be dual regulated. And this dual regulation between the two regulators and supervisors, still there is a memorandum, for example, between the two, that is going to dictate what the Financial Conduct Authority should look at, what the Prudential Regulation should look at. But then in reality, this is just a memorandum, it's soft law, it's not something that is within the law. And that is where some people, they think that there is a lack of effective coordination in the Twin Peaks model. But so far, it worked well. I mean, there were not major incidents. So it's not something that was impossible to overcome or didn't produce the effect of the Financial Services Authority. This is something interesting, I mean, in the sense that today, if you think, until now we spoke about the global financial crisis. In the global financial crisis, there was a lack of liquidity. So everything at the moment of the global financial crisis and post-global financial crisis was focused on liquidity, backstop liquidity, how we can give liquidity to banks that are going to fail. So that was the philosophy and what in reality banking regulation was about, to provide liquidity to a failing institution. But this kind of discourse today has shifted in regulatory debate into resilience. So today there is, and this is something that we have seen also with Professor Lastra once she was in a public inquiry of the House of Lords in relation to non-bank financial intermediaries. So there are banks and there are non-banks. These non-banks are crypto asset firms. These non-banks are pension funds, mutual funds, hedge funds, alternative investment funds. They are all non-banks because they are not subject to the same rules of banks. But sometimes they can perform functions that are similar to banks. They might lend to people like a bank, like a commercial bank. So there is an idea of shadow banking, and there is an idea of ventures between the two, where also banks, they cooperate with those shadow banks or non-banks, and there are no rules on the point. And that is something where we need to take a position that still we don't know which position will be. But one idea can be to make a non-bank financial intermediary more resilient, so that if the non-bank financial intermediary is going to fail, still this kind of cost will not be paid by the public, by the taxpayer, but can be paid by the institution itself. So we try to make maybe those non-bank financial intermediaries more resilient. That means maybe to add capital requirements, to add liquidity requirements. Because a lot of debate in this is that whereas in banks everything is public and balance sheets are public, so you can watch this on Google, you can have a vision of the annual report of Barclays on Google, so it's public. All the balance sheet of non-bank financial intermediaries are not public, and also there is not enough data on the point of this cooperation between the two. That is why there might be a concern for systemic risk, but we, even the House of Lords in this country, has said in the report that they don't know still whether the systemic risk is exploding or not, and how it's exploding, because there is not enough data on the point. For example, even asset managers, and Apollo is one of them, that is going to diversify assets and investing in different assets, different line of business. That is one of the cases where there are a lot of off-balance sheet items that are not visible. And that is where actually there is a problem. Then the problem is always the same, because it's a lack of liquidity. All the crises in general in history, and always will be like this, are generated by a liquidity risk crisis. So in reality is liquidity the main problem. That is the commonality between banks and non-banks. But then how they operate and how the data is in reality collected, that is different. We have much more data for banks, we have much less data for non-banks, non-bank financial intermediaries. But still they might generate systemic risk. This is why this kind of regulatory debate then has shifted to resilience. In Brexit, I mean, we already commented on this in the last slide, the corridor and so on. So, Brexit, you find this already, what we said before. Any question, because we almost reached the time? Yes?
From before, since we have time, can you explain again the difference that they ask
Yeah.
between the over-the-counter and the alternative listing?
Yes. that to list on the market, the main methodology to list on the market is the initial public offering. So we have IPO. So that is the main way to list on the market. But then we have here below we have other two ways. One is SPAC, but we speak about SPACs at the end. So the last lecture is with me. We speak about this alternative way to get listed. And then the other is direct listing. So there are two different ways to get listed. But the main route still today, the traditional route, is IPO. In fact, today we speak about traditional IPO because we want to distinguish traditional IPO from SPACs and direct listing. We will speak, yes, in the last lecture, we will speak about this. Sorry? Yes, it's finished. No, it's fine. Yes, of course. Yes, finished. Thank you very much.
Can you just repeat what you said about the banking?
Yeah, and go on.
Yeah, sure.
Oh yeah, go ahead. We were there for like 5 days. We had like breaks in between, so 5 to 12. Artemis 2. Let's see.
This was the call.
Yeah, I signed it.
I forgot the code. So.
You need to go a little bit more to the left because you can't pass like this. Okay.
Are you January? Okay. What
Still have to get permission. How was it?
What a miserable evening. That weather is awful. My apologies for last week. I hope you got the message early. Did you? Yeah, sorry. I was ill. I sent the message and went back to bed. So what we're going to do today is we're looking at intermediary liability, and then there's an extra class which has been scheduled, which I will check the date of. It should have been added to your timetables, so it should fit with what everybody is doing. But I'll check the date. Can you see it in your timetables? Yes, it's going to be on. Let me just check what date.
Oh, it's on Thursday. Oh, wait, no.
So, so okay.